Hello, everyone. Matt Clark, research analyst with Money and Markets, and your host of the Bull and the Bear podcast with your kind of weekend edition. We come out on Friday, but you have the whole weekend to digest all the information that we provide to you here with the Bull and the Bear, and that is what this episode is. And fortunately, joining me today is going to be Money and Markets editor Charles Sizemore, almost forgot his name, and chief investment strategist Adam Odell. They are going to be with me here shortly. But first, I do this on a regular basis, and what I want to do is I want to make sure that if you haven't already, that you head over to moneyandmarkets.com. And what we offer there is each and every day, Sunday to Saturday, we give you safe and sound, profitable information for your portfolio. And that comes from myself, it comes from Charles, it comes from Adam, it comes from a wealth of other people. And we provide that to you basically for free. And go on to moneyandmarkets.com. It's moneyandmarkets.com. And make sure you sign up for our free e-letter, because we do put out a free e-letter that comes into your email box each and every day, including Saturday and Sunday. And you will get that safe and sound, profitable information. So make sure you head on over and do that. Now, to jump into today, one thing that few people really know about me in particular is that I love data. I am a data nerd. Maybe this started whenever I started collecting baseball cards as a kid, and instead of oogling over the picture of whoever was on the front, I would always slip the card over on the back and read the stats for the last 10 years of each baseball player. I read their batting average, their on-base percentage, win-losses, saves, strikeouts, whatever it happened to be. I would always read that because that would always tell me a better story. I mean, looking at the picture is great. But I always got a better feel for the player when I saw the stats. And that carried over with me when I became a journalist. I started in sports, and I loved it because, sports is based on data. It's based on numbers. And the cool thing about it is that numbers don't lie. And so whenever I morphed into doing political reporting and investigative journalism, that love of data just kind of carried over with me, because the bold fact of the matter is that people lie. Data doesn't. And I would always get a better story whenever I had more data at my disposal than I would if I had to interview more sources, because sources can tell you whatever they want. Data, on the other hand, is very, very truthful. And now my new role here as a research analyst for Money and Markets, and what I've learned with Adam Odell and Charles Sizemore is kind of the same thing, is that you can use data to pick out trends and to spot different things in the market. And the more data you have, the better those trends can be spotted. And, headlines are great. Headlines will move the market, for a day or for a couple of days. But if you're looking for long-term trends, then you really have to look at data and see what the data tells you. And data tells me that at least over the last 6 months or so, maybe even longer, there's actually been a trend involving electric vehicles. And investors are really salivating over these stocks. They're really just pouring capital into buying companies that have to do with electric vehicles or autonomous driving. And one thing that kind of illustrates that is if you look at an ETF called the Global X Autonomous and Electric Vehicles ETF. It trades on the NASDAQ. Its ticker is DRIV. Now, it's an exchange-traded fund that holds some of the biggest autonomous and electric vehicle players in the market. And after hitting a low of around $9 a share back in March of 2020, the ETF has now made a 177% jump to where it is today, which is around $27. And this follows, EV companies throughout, and some of the biggest ones. So what that indicates is that there's a big interest in this, in electric vehicles, autonomous vehicles, things like that, by investors, whether that's hot, whether that's just something that's passing. That's the interesting thing. And I think what we need to do here is examine a couple companies within that ETF and within that market to see kind of whether this is just a short-term thing, or maybe it's just maybe it's just a bias, maybe it's a behavioral bias. So that's what I want to do, is I want to bring in Money Markets editor Charles Sizemore and chief investment strategist Adam Odell and talk about three different companies. And the first company, first off, welcome. And second, the first company is very, very well known. In fact, when it comes to EV, it's the one it's the one that's in all that. It makes all the news. It's a giant. It's got an $805 billion market cap. It's coming close to that $1 trillion mark. 1-year annual sales growth rate of just 15.4%. It tallied $28.1 billion in trailing 12-month sales. It's surprised Wall Street analysts in each of the last 5 quarters for earnings per share. For sales, it's surprised in 3 of the last 5 quarters. In the last 12 months, the company stock has risen more than 700%. as it was recently added to the S&P index. And if that doesn't give it away, then I don't know what will. It includes that price jump includes a 5-to-1 stock split the company undertook back in September. The company here, obviously Tesla Incorporated, trades on the NASDAQ under TSLA. Now, I have my own thoughts about Tesla, and I've made those clear. I'm going to make them clear again. But first, I want to bring in Charles Sizemore, editor for Money and Markets, and get your thoughts on Tesla. Charles, it's made people a lot of money, especially Elon Musk. But is it really a company you want in your portfolio?
Well, before I get into that, a couple preliminary points. First off, don't feel bad about forgetting my name. My own mother called me the cat's name a few weeks ago. The cat. So just
in all honesty, I think I was just talking too fast and I just stumbled over your name. It wasn't necessarily that I forgot it. It's just that I just stumbled over it. And I'm not going to call you.
My mother didn't forget my name either, but she still called me the cat. So
interesting. And what's your cat's name? Just so we can all use that as a joke later.
Well, we'll just keep that off camera. Anyway, another point. I also was a stats nerd with my baseball cards. I don't even remember what the front of the card looked like half the time. It was just always the numbers on the back. For a brief part of my adolescence, I actually wanted to be a sports statistician when I grew up. So gotta love that. And then final random factoid of the week. Data is actually a plural word. It is the data are, if you're going to be strictly correct in your English. The singular is datum. The datum is. So most people don't know that, but now we all do.
What an educational lesson we've all received.
Well,
you want to tell me about Tesla, or do you want to tell me about Tesla?
So Tesla is interesting. I like the cars. I think it's a cool company. I've been a skeptic on the stock for a while, and I've been wrong. I mean, the stock went up from its lows to its highs over the last 52 weeks. It was a 10-bagger. It's been incredible. Now the question is, does that continue? Well, I would have said it couldn't continue a year ago, and here we are, right? But I would say this: at this point, after the run it's had, Tesla is now the 5th biggest company in the S&P 500 by market cap. This is not some small cap that can, explode higher. This is one of the biggest companies in the world. It's worth $800 billion. So the question I would ask, and there's no point in even discussing Tesla's fundamentals because this stock does not trade on fundamentals. It never has. If it traded on fundamentals, it would be worth probably 1/100th of what it is right now. But based on momentum, this is a momentum stock first and foremost. How much new money would have to pour into this stock in order to make an $800 billion, a nearly $1 trillion company continue to explode higher like it has? And I don't know the answer to that. I mean, there's obviously some amount of money that would make that happen. But if all markets are a function of supply and demand, that's a lot of new demand that has to materialize. So I'm a hard pass on Tesla.
Okay. Chief investment strategist, Adam Odell, another probably out of the, all three of us are probably big numbers guys. And I know that you really look at data on a regular basis, on a daily basis, almost by the hour. What are your thoughts on Tesla?
Yeah, so I'll say that on a numbers basis, we use our 6-factor green zone rating model, and it looks at momentum, size, volatility, value, quality, and growth. And of the 3 stocks we're going to talk about today, I'll give a spoiler that Tesla rates the highest of these 3 stocks, and that score is a 43 out of 100. So typically in our green zone fortune service, where we buy, we try to add one new stock, with a holding period of 6 months to 3 years per month, and we try to add that to the portfolio. We want to buy high conviction stocks that rate highly on the green zone's 6-factor rating model, usually about 80 or above. So Tesla would not, on that basis, qualify. That said, I mean, I appreciate your love for data, and I'm the same way as well. I mean that plurally, because you do need to look at more than one data point or datum. But you have to decide: are you trading a price? Are you going to trade a stock because it has price action? And if you're doing that, you need a momentum only system. You can do that. Realize I've traded foreign currencies and commodities, and a lot of those, it doesn't really come down to fundamentals as much. It comes down to price action. So if you're doing that, just know who you are. Know that you are a price action only momentum trader, and follow a system, a strategy that'll do that regardless of the fundamentals. Otherwise, if you want to be more of an investor for the long term and you want to be more of a buy and hold investor in good companies that have good valuations and good profit margins and good growth rates and have good momentum, then you really want to use something like our 6-factor rating model. So on the basis of that, Tesla would be a hard pass for me. If you want to trade it, you certainly can trade it. I will say that it has everything of a cult bubble stock. It has all the characteristics. Retail money's pouring into it. New Robinhood traders. No offense, I'm not trying to be demeaning or whatnot, but new Robinhood traders are pouring into it. It's in the news. Elon Musk is controversial. It's kind of like Trump. You either love it or hate it. Everybody's got an opinion on Tesla. So somebody asked me about Tesla on an investment conference call the other day, and I said, you're probably better off buying long-dated, out-of-the-money puts on Tesla than anything else. And I followed that up by saying, but I would have said that a year ago, and all that money would have been washed away. So at this point, I think Tesla's a stock to trade if you know how to trade. But otherwise, as a fundamental investment, I would not be buying it.
And Charles, you mentioned fundamentals and how you didn't want to get into it. I'm just going to mention one number. Well, actually, I'm going to mention two in comparison. In the auto industry, the average PE ratio is 47.2. Tesla's PE ratio, 1,600 and I believe 97. So the price to earnings ratio for Tesla is unreal. And to me, it's way overvalued. I think I agree with both of you. I think this is a cult bubble stock. Of course, yes, we said this a year ago, we would have been wrong. And that's true. But if you're looking to be a smart investor and to make long-term plays, Tesla's not it. Just this volatility is way too high. Obviously, it's got strong momentum now, but no one really knows how long that's going to last. One headline changes things completely for a company like Tesla. One wrong tweet by Elon Musk changes things completely for a company like Tesla. I'm kind of with both of you. I'm a hard pass on Tesla. Again, love the products. I think the message is great. The cars appear to be, no longer bursting into flames on random roads in China or Texas or here in Florida. But the products seem to be fine. They look nice. I would consider buying one if I really thought long and hard about it. But in terms of stock, I'm just not there. The second company on our list is one that actually designs and manufactures and sells electric vehicles in China, and they sell them in Hong Kong, the U.S., the U.K., and Germany. They develop and sell mid-size electric sport utility vehicles as well. They've got a one-year annual sales growth rate that actually blows Tesla out of the water. Their one-year annual sales growth rate, 45.7%. One-year earnings per share growth rate, 44.5%. Company surprised Wall Street analysts in each of the last 5 quarters in sales and 4 of the last 5 quarters in earnings per share. The company's stock, if you think Tesla has made a massive run, this company is actually even bigger. In the last 12 months, this company's stock has jumped 1,500%. Which is significantly greater than 188% that the average stock price for consumer vehicle and parts industry stocks have gone up. This company is Nio Incorporated. We've talked about it before on the Bull and the Bear podcast. Actually, I did a comparison with Nio and Nikola. Make sure you check out our YouTube channel and find out what I had to say there. But it trades on the New York Stock Exchange under NIO. And first, I'll send it to Charles. Charles, this company, in terms of growth and momentum and things like that, it actually really is a much better company than Tesla, but does that necessarily make it a buy for smart investors?
Well, I'm going to go back to my point about Tesla, and that was, given that Tesla is an $800 billion company, almost $1 trillion company, the amount of new money that would have to flow into it to make it continue to explode higher is not there. I mean, the best you could really hope for in Tesla, best case scenario, is that it kind of tracks the market, right? And probably won't even do that. In the case of this stock, it's a much smaller company. It's about 96, 98 billion. I mean, 98 billion's obviously not chump change. That's still a massive company, but it's 1/8 of what Tesla is. So if you are looking for something that can potentially continue to explode higher as sort of a short-term to medium-term momentum play, then I would say this stock is doable there, right? I'm still a pass as a long-term buy and hold investor. I mean, I'm not comfortable holding it. But as a shorter term trade, sure, why not? I think it could be interesting as a short term trade.
And by short term, you're thinking 3 months?
1 to 6 months.
Okay. Adam, again, here's a company that has, in terms of momentum is actually stronger than a company like Tesla. Fundamentally, however, there's a lot of struggles here. What do you think about Nio?
Yeah, unfortunately, I have a pass on Nio as well. It rates a 6 out of 100 for many of the same reasons that Tesla rates poorly. It's been around even less time. It is smaller, so it rates a little bit better on that. But, I kind of want to use, I'm pass on Nio, but, I think that this is a good opportunity to use the point that, in Green Zone Fortunes recently, we had a subscriber write in, and we're holding a position which we intend to hold for 3 years. And this subscriber wrote in and said, I've hit your Money and Markets website. I've punched in the ticker of this symbol of this stock into the Green Zone rating model, and it rates a 25 out of 100. So why the heck is it in our portfolio? And I got this question a couple of times, and the answer is, in short, I had to look past our Green Zone rating model. I had to look through it and figure out, this company is new. The stock has only been trading since October of 2018. So what do I expect this company's metrics to be in 3, 5, or 10 years when it has enough metrics to get a full rating on the system? And really to do that, and this is not a trade that we put on. I mean, this is the position's up about 250% right now, but this is not a short-term trade that we're intending to hold for 6 months. We're intending to hold it for 3 years and hopefully get a 10-bagger. So really, the second part of the answer to that question is, well, why is it in our portfolio? It's because I spent about a year researching that company. So in 2019, I spent about 10 months researching the genomics industry, which is basically biotech on DNA, is a kind of a layman's way to explain it. And I gave a presentation in October of 2019 at an investment conference where I called DNA, or the genomics field, the future of everything in healthcare. But it took me about 10 months of research to really come to the conclusion that I was willing to put my neck out on that. And then it took me about another further 6 months or so to research this one individual company that I ended up recommending in Green Zone Fortunes this year. It's up about 250%. So really, what I'm getting at is if you want to look beyond the data, if you want to look past the Green Zone stock rating model and buy into a stock that isn't rated highly, you really have to do your due diligence. You really have to put the time and the effort in to do research, that roll your sleeves up and read everything you can about it and make discretionary decisions of whether that is the future of the market and of the industry. And so, I mean, one thing I'll say is that I'm not bearish the EV, the electrical vehicle market. I think it will. I think things are shifting that direction, but there is a limit to the size of that market. I mean, what if everybody in the U.S. or everybody in the world had an electric vehicle tomorrow? Then what? How big is that market? Whereas the healthcare industry, more broadly, and the biotech industry and the genomics industry, if we can build out the solutions within the DNA targeted precision medicine solutions that genomics is promising, the market for that is just so much more massive and so much more pervasive. So Joe Davis, the chief investment strategist or officer of Vanguard, gave a presentation that I was at, and he called basically the genomics field the most promising field in our generation, because it's going to spawn off so many other technologies, and you really don't see that necessarily in electric vehicles, which in my opinion is a little bit more narrow. So Green Zone Fortunes readers, if you're listening, you know what I'm talking about. Otherwise, you can sign up for the service for a very nominal fee and get the research on that industry group.
And the good thing about it is that the three of us together, we will do that research for you to help find those companies like this one Adam is talking about that he recommended that is up massively. And I'll just drop in a quick plug here. If you do want to learn more about this service and how you can be a part of it, just head over to theinvestingsecret.com. That is theinvestingsecret.com, and you'll find a way to jump on. Actually, part of that is going to be Adam's Millionaire Masterclass that will provide you with a ton of information and how you can be involved in Green Zone Fortune. So I'll do that as well. I'm also a pass on Nio. I think it's better than Nikola, which I said in our video. But I think between Nio and Tesla, I would lean more towards Nio than I would Tesla. But I'm not really set on either one of them, so I'm kind of a pass there as well. Now, the last company here I want to roll through kind of quickly. This is a one that develops hydrogen fuel cells for electric mobility, stationary power markets. It focuses on fuel cell, battery, hybrid technologies. It's got a one-year annual sales growth rate of 63.7%, a one-year annual earnings per share growth rate of 24.8%. The stock, very similar to Nio, has risen 1,500% in the last 12 months, and a lot of that rise has come here in January. So since the end of December to January, the stock has climbed pretty significantly. That compares to just a 103% increase of the average stock price in the electrical equipment and power systems industry. So it is besting the market by a long shot. This company is called Plug Power Incorporated, trades on the NASDAQ under PLUG. And real quickly, Charles Sizemore, your thoughts on Plug?
You know, if you put a gun to my head and said, you have to choose one of these three stocks, you got to buy it and hold it for the next 5 years. Yeah, you can't sell it. You have to choose one of these three. This would be the one of the three I would choose. All of that said, I'm still a pass on it. There's just too much speculative froth. I would say if there was any stock that could maybe grow into its valuation, it might be this one. But that's really not a very strong conviction statement right there. For me, it's just a little too frothy, a little too speculative. If you're a swing trader, or if you're just a very short-term momentum trader, by all means, hitch your buggy to this horse and let it run. But know when you're going to get out. That this is, if you decide to trade this stock, make sure you have an exit strategy in place. Know at what point you're going to sell, under what conditions, because this is not a buy and hold.
Adam, same to you. This company, I've noticed over the last couple of days, while in January it's had a nice big run, but just the other day, the stock actually fell about 6 or 7% in a day, and then it started to build back up again. So what are your thoughts here on Plug Power?
Yeah, the market just opened, and Plug, I think, closed yesterday around $70, and it's opening at about 66, so it's gap down. But nonetheless, a few thoughts on Plug. It has to be a pass for me based on its long-term fundamentals. If we just look at that, it is a trader stock. It is become something of a cult stock. I like the company's technology. I'm kind of with Charles in the fact that I think they have something unique, and I think as they build out their platform, it'll gain traction over the next 5 to 10 years. Really, you have to look at these stocks as like, we may have a different answer at different points in time. So earlier in the year, my Cycle 9 system gave a trigger on this. In full disclosure, I didn't actually recommend it, but that would have been a good time to get in around the turn of the year. If it is a good time to get in today, no, not necessarily, because the stock's up 100% in the past week or so. So also to give props, we do have an editor, a guru in our group, Paul Mampilli. And I don't know the details, but I'm pretty sure he recommended Plug a bit ago and made a massive return for his readership. So I'm certainly not a hater. The people that can dig into companies like this and know what the technology is and know the right time to buy into them, I think that they can provide a lot of value for retail investors who follow that trend. The good news about this type of stock and the type of stock that I was just referring to in the genomics field is that even after they have massive runs of like 200% or 500% or 750%, you're probably going to get a second chance to get into that stock on a pullback. And I wrote about this recently when I was kind of coaching my readers through, why are we not locking in a 250% profit? And, why should we expect a pullback of 20, 30, or even 50% ahead in this stock? And when that pullback comes, why should we not be sellers of the stock, or why should we actually add to our position? And I did some research on Amazon. And if you look back at Amazon's gone through something like 7 or 8 individual pullbacks of 30% or more. And the point of that is to earn the multi-1,000% return in Amazon. If you bought in the early aughts, you would have had to sit through, a number of, very serious declines and not be tempted to sell the stock there. So the point is if you have conviction in a stock, in the company for the long term, even if it's a volatile momentum stock that runs up too far too fast now, you're probably going to get a second chance to get into that stock on a deep pullback of 30, 40, 50% if you're patient and if you know what you're going to do when that happens. So that would be my assessment of Plug. I would not buy it now. I'd wait for a pullback and then see if you can get in at a better discount.
And you completely stole my thunder, because that was exactly what I was going to go with. Was it's seeing a lot of great momentum, and of course here at Money Markets we talk a lot about buy high, sell higher. But there's a point in time where that momentum is too much. And I say that may not necessarily be the right way to say it, but where the momentum has kind of reached its arc. And I think that a company like Plug Power, again, I'm kind of with you guys. I love the company. If there was one of these three that I would, recommend to buy, then Plug would be it. I just think the timing of it is not right. I think there is a pullback on the way for all three of these companies, really. But in terms of potential value and probably a best bet, I think Plug has the best opportunity to not only test the high, bounce down to 20-30%, and then come back and even go above and break through its resistance, which is where it's at now at about $70. So again, I wouldn't buy it now, but I would certainly keep my eye on Plug Power to wait for that pullback, wait for that dip, and then maybe jump in when you see that 20%, 20, 25%, 30% drop off. So all three of us kind of passes on all three of these companies: Tesla, Nio, and Plug Power. Again, not that these are bad companies. That's the one thing that you can't misconstrue here, is that we don't say these are companies that are bad companies or the ones that you shouldn't ever buy ever. It's just the timing of it right now. When we discuss it, the timing of it tells us, and the numbers, the data tells us that now is just not the time to get into any of these three stocks. And the time frame of which you could get into them or should get into them will vary. That it's not uniform. It's not, okay, in 3 months I would say get into Tesla. That's not true, because we just don't know what's going to happen. But the data tells us that right now is not the best time to get into any of these three stocks. Again, not that they're bad companies, not that EV doesn't have potential, because it certainly does. It's just not the time to jump into any of these three. They've all had solid runs, but I think those runs are going to be coming to an end, and you're going to see pullbacks. So that's what we have on those three. I do want to thank Money Markets editor Charles Sizemore, as well as Chief Investment Strategist Adam Odell, for joining me this week. Remember, head over to moneymarkets.com. Make sure you check out all the free content we have on there. It's all safe and sound, profitable investment information for your portfolio. Stuff by Adam, by Charles, by myself, and many others on there. Sign up for our free e-letter that comes out each and every day, 7 days a week, and curates that content for you and gives it to you. Just go to moneymarkets.com. You can check out the Green Zone Fortunes, the Green Zone ranking system. Play around with that. That is a great tool to have. That is also free on our website at moneymarkets.com. So check all that out. So for Charles Sizemore and Adam Odell, I am research analyst Matt Clark. Until next time, everyone, safe trading.